Hello, this is Naresh Karamchetty. Today I will talk about covered call options. First, a quick introduction into what call options are. The buyer of a call option has the right, but not the obligation, to buy shares of stock at the specified strike price up until the date of expiration. The seller or writer of a call option has the obligation to sell shares of stock at the specified strike price up until the date of expiration if the buyer chooses to exercise the option. A covered call is a financial market transaction in which the seller of a call option owns the corresponding amount of the underlying instrument, such as shares of a stock or other securities. Writing a call generates income in the form of the premium paid by the option buyer, and if the stock price remains stable or increases slightly, the writer will be able to keep this income as a profit, even though the profit may have been higher if no call were written. When you enter into a conventional covered call trade, you are pledging to sell your shares at a certain price on a certain date of expiration. For pledging your shares, you will be paid a premium. Because it is a limited risk strategy, it is often used in lieu of writing calls naked, and therefore brokerage firms do not place as many restrictions on the use of this strategy. A naked call is one where the writer does not own the underlying stock. This is a highly risky strategy because if the stock is above the strike price when the option expires, then the call writer will have to pay the difference, which is often much more than he received as a premium from selling the call option. The most obvious reason for an investor to sell covered calls is to reduce income on stock that is already in his portfolio. Or an investor likes the idea of profiting from option premium time decay, but does not like the unlimited risk of writing options on covered, primarily for the reason previously mentioned. The investor feels that in the current market environment, the stock value is not likely to appreciate, or it might even drop some. As a result, he may decide to write covered calls against his existing position. If the option is still out of the money, it is likely that it will just expire worthless and not be exercised. In this case, he need do nothing. The investor can then roll out and write another option further out in time. Although there is the possibility that an out-of-the-money option will be exercised, this is extremely rare. Exercising an out-of-the-money option means that the buyer is paying more for the stock than he would have to on the open market. If the option is in the money at expiration, then it will be called away, and the investor loses out on any additional gain should the price of the stock increase any further. A risk of major loss occurs if the stock price drops by a large margin before the option expires and the option is not bought back. The stock cannot be sold while it is covering an option. However, a drop in the stock price causes a drop in the call option premium. Therefore, the option can be bought back at a lower price than it was sold, making the investor a profit on the option transaction. Since the investor is counting on time decay of the short option to render the short call worthless, a general rule of thumb is not to sell a call more than 45 days out. Now you know what covered call options are and how and when they should be employed. Until next time, good investing.